Good evening, everybody, and to those in Cape Town. Before I start, I just wanted to mention that whenever we get ahead of ourselves, Mark is very quick to remind us that there are only three things that we can do to make our business successful. The first one being astute asset management. The reason for that is the right investment choices result in securing long-term leases at market-related rentals, and that in turn translates into capital appreciation over the long term. The second is tight cost control, and the third is prudent management of funding. I hope after the conclusion of my section here, you'll be able to confirm that Redefine has ticked every box and some for the new financial year. Turning on to our 2013 financial highlights, we're very pleased to announce that the results are ahead of market guidance. Our distribution growth is 7.3%, and we had a very good second half, up 7.7%, and part of it was due to the rand depreciating to some extent against the pound, and that assisted us to give a little bit extra to what we promised the market. Our distributable income for the year exceeds 2 billion rand, which is quite a substantial number, and in rand terms, our distribution has grown by 15.5%. Our balance sheet, which I'll show you in a short while, has been transformed and has been strengthened as a result of the inclusion of Fountainhead in this financial year and the exclusion of Redefine International, which is now equity accounted, which was consolidated in the previous year. When we get to the NAV slide, you'll see a very pleasing outcome. We're up 69.3 cents to just under 8.71 rand, which in itself is a great achievement. And then I think we must go back to our active portfolios margin. You'll see a pleasing increase there, up to just under 78%. Our average cost of debt, as you heard from Mark, is 8% on average for the year. That's a reduction of 90 basis points on debt in excess of 14 billion rand. You can imagine it's quite a sizable saving for us. But going forward, there is some task, given that the swap curves have become unkind to us, principally driven by the threats of quantitative easing coming in. The market has overreacted in our view, but it hasn't come back to a level which we think offers good value if you're fixing over the long term. Our equity is up 1.7 billion rand. That was as a result of issuing shares for cash for 800 million, and 900 million rand was in respect of the Fountainhead acquisition that we did earlier on in the financial year. Our total tangible assets are 44 billion rand, and our debt capital market presence continues. We currently are sitting on about 2 billion rand of bonds, and 1.5 billion rand was raised in this financial year. Just looking at our corporate structure, you'll see it has become simplified. We're looking all the time to make it more understandable and easier for the analysts to model. You'll see that Redefine International now is treated as a direct holding, given that on Monday, Redefine International PLC was inwardly listed, and Fountainhead Property Trust now is consolidated, given that we control it on a number of different levels, not just on a straight legal interpretation, but also from an accounting interpretation. And last but not least, you'll see that the Cromwell Property Group, through Redefine International and ourselves, as a unit, we hold about 26% in Cromwell. Just looking then at our distributable income, as Mark said earlier, our non-recurring fee income is still there, hasn't disappeared, and it won't, but it's become less of a feature in our numbers. We don't see any reliance on that anymore, and that speaks to the solid base from which we operate. If you look at the split of the first and the second half, you'll see the growth I spoke of earlier. Just looking then at the contributors to the 68.7 cents, you'll see that about 70% of our distribution comes from Redefine on a standalone basis. That is stripping out the contributions from our listed securities. Now, within the Redefine number is funding costs, and also I've spread the additional units in issue across all the numbers. So if I attribute the extra units that we issued during the year to the various assets or listed assets that we acquired, being Fountainhead, principally, and Cromwell to some extent, and also the funding costs that we incurred to support Redefine International in terms of their rights issue, that Redefine's contribution grows to about 75%. Our listed securities on a combined basis is just under 21 cents of that 68.7 cents. And that's a number just to keep in the back of your minds, because later on I'll talk about that a bit more. This slide isn't here to confuse people. It's here for the academics or the accountants. We always ask the question about our distributable income. How does it talk back to our IFRS income statement? The truth of the matter is the two don't talk to each other. We have to do quite an extensive and confusing reconciliation. And this will be Redefine's last distribution as a property loan stock. So this will be the last debenture interest distribution, which essentially is our income that we distribute. Non-capital income, I should say. Whereas as a REIT, as you know, it's more of a tax-driven nature. And this reconciliation will feature quite prominently going forward to demonstrate to the public at large that we're not distributing capital to make up shortfalls in expectations. If there are any questions later on, please don't hesitate to ask me or Leslie, my colleague, who's more than able to explain what's happening. Just looking then at the drivers of the growth in distributable income, you'll see that 194 million rand of the growth came from the net operating income from our investment properties, by far the largest contributor. Listed securities has grown. That's principally due to the acquisition of Fountainhead. Fee income, that's now recurring. All of that growth is from the Fountainhead Management Company that we acquired. You'll see there that administrative costs have increased. Some of it is due to the extra marketing awareness that we've created out there. It's been in for a full year this year as opposed to a partial period last year. But in addition to that, there are extra costs that we have incurred in providing support to the Fountainhead Property Trust. And there is fee income sitting against that, well, rather the fee income sitting in the top line. So we could net the two off, but for transparency, we've separated the two. Share of distributable income from associates, as you can see, has declined. That's not that we've lost that revenue, it's just gone elsewhere. That 19 million has actually gone to listed securities income. That was Cromwell, which is no longer regarded as an associate because of the deconsolidation of Redefine International. It's now treated as a listed security. And then you'll see finance charges are up 78 million rand, a big number, but bear in mind our debt has grown by about 2 billion rand. So if you factor that in, it's by no means a substantial increase given the extra debt on our balance sheet. Redefine International, as you can see, is 50 million rand up on its position last year. Once again, a big chunk of it came from the pound, and probably in even measures, there was also an improvement from the underlying business given the equity or the rights issue that they did early on in the financial year. Just looking at a simplified distributable income statement, this essentially for us is how we look at our business, which is probably the simplest way to do it, and that is to take our operating income from our investment properties, which I'll go into a lot more detail, and then add on all the other bits and pieces. For example, Fountainhead, we treat it here as a listed security, whereas in our books, you'll see that they're consolidated. So it gets very, very confusing. On this basis, it's much easier to model, and I would urge people rather to do it on this basis, because if you try and get into the numbers with contractual rental income and costs and so forth, it's going to probably give you a lot of trouble in terms of accuracy. Listed securities, 322 million. As you can see, it's slightly down. That's mainly due to Hyprop that we've used as currency to acquire Fountainhead units. I spoke about our fee income already. Our property trading income, that's another feature of Redefine that's it's basically in extinction, if you like. It was one of our strategies, was to get out of speculative trading, and as you can see, it's becoming a non-entity within the numbers. Administrative costs I've spoken about, and I think if you want more information, you can look at the published results. It's available on the web. It's also in your booklet. We also split the numbers out between Fountainhead, ourselves, and International in a lot more detail. Looking then at the active portfolio. Our active portfolio, the way in which we categorize it is that it's properties that have been owned in both periods for 12 months. So it's a like-for-like comparison. As you can see, we've grown our active portfolio revenue by 7.2%, and that's principally off holding costs essentially flat. I'll go into a lot more detail on those costs. As you can see, that is a pretty good achievement, given a lot of cost pressures out there in terms of administered costs being electricity and rates and taxes. Our active portfolio revenue has grown just under 6%. I'll also speak a lot about that in a short while. And the balance of the growth, taking the 7.2% on the active portfolio up to 10% overall, is mainly due to properties that we've acquired that are coming on stream now and weren't in the prior periods. A pleasing feature is the margin. As you can see, 78%. It's 1% ahead of the prior position. And once again, I've got a slide there to show you exactly how we were able to achieve that. Looking then at the revenue, you'll see that a very difficult time has been experienced on the letting front. Overall, you'll see that new lets have provided us with 84 million rand of extra income. However, we lost 86 million rand through vacancies. Now, we were very lucky in that we have a diversified portfolio, and this is a perfect illustration thereof, because if you look, you'll see that our industrial portfolio had quite a big knock. We had 2 properties that went vacant during the course of the year, causing quite a big or substantial shortfall in revenue, 36 million, and we were only able to cover it to the extent of 22 million rand. That deficit was made up by retail, which you can see did very well. We had new lets of 37 million rand as opposed to vacancies of 24. Offices held their own in this difficult market, despite the churn that's going on. So year on year, you see the growth at the bottom there. Industrials had a tough year, but retails had a fabulous year, growing just under 10%. Overall, as I said, just under 6%. If you just look at the expenditure, you'll see that on the second line, electricity charges have gone down by 3/4. The reason for that is through the internalization of electricity charges, as well as a number of electricity savings initiatives that we've adopted on our buildings. There's been a concerted effort on municipal charges. You can see that in our recoveries on our municipal charges. They've gone from about 68% to 72% over the period. And all the other costs, as you can see, we've tried to contain as best we can. Property management has gone up quite substantially, but that is a deliberate strategy to improve our property management capacity, especially in the retail area, an area where we were probably a little bit shallow historically, but now are beefing it up to take on these new properties that we are acquiring. The other costs are generally in line with activity. Bad debts, as you can see, is basically in line with last year, but that was mainly due to a substantial write-off in the prior period. Just to look at the trading efficiency, you can see that for every 100 rand of property revenue, how much falls to the bottom line and where the consumers are. But before I go there, if you look at the property margin from 2010 through to the current year, you'll see that on average, we've been able to improve our margin by about 1 percentage point per annum. Now, that's going to become quite difficult as we go along. We're not going to have the benefits of initiatives such as the internalization of electricity beyond 2014. So we're going to be hard pushed to maintain these margins from 2015 onwards. But as you can see, for now, we have done very well. The big decrease or the big push in decreasing our property margin, apart from the electricity savings that we've engineered, is on the management fees. That's the second line from the bottom, where you'll see in 2010 it sat at 4.4%, currently at 0.8%, and that's mainly due to the internalization of property management. This is once again for the academics. This is a statement of financial position. The 2 middle columns are the columns to focus on. What we've done here is we've included on the 2 outer columns the published numbers. The 2012 group has redefined international consolidated, and it has Cromwell equity accounted. And the 2013 group has Cromwell treated as an investment, redefined international deconsolidated, but Fountainhead consolidated. So very confusing and almost impossible to make sense of. But if you look at the middle two columns, that's what Redefine's management is charged with. And once again, if there are any questions, happy to answer them. I just want to draw your attention to the non-current assets held for sale, and similarly the non-current liabilities for sale. There are substantial numbers in both those two lines, and they're made up in the assets case, mainly the 2.2 billion property portfolio that we're wanting to list next year, the government office tenant portfolio, and about 2 billion rand of high-prop. And then there's debt of about 1.8 billion rand in the 2 billion rand below that in respect of expensive debt that we're going to be restructuring as part of the office portfolio. Looking then just at our listed securities, once again, they're all over the place in the balance sheet. I've just provided a map here back to the balance sheet to give you a point as to where they're located. As you can see, Cromwell and Arrowhead, it's a very small investment in Arrowhead that we've got, sits under listed securities. As a subsidiary, we've got Fountainhead. Now, you'll see the market value of Fountainhead is 4.3 billion rand. This was as at 31 August. But what has been consolidated from a net asset point of view is just under 4.1 billion rand. Redefine International is treated as an associate, 2.3 billion rand from a market value point of view. However, if we equity account it, we're only putting 1.7 billion rand onto the balance sheet. High-prop is a held-for-sale asset. We've spoken about that. Just looking at our funding, the reason why I've done an analysis of Redefine is because the Fountainhead debt and its assets, given the nature of the PUT vehicle in which those assets and liabilities are located, they are ring-fenced. So from a credit point of view, it serves no purpose to look at group statistics, because you can't attach those assets, you can't, the debt isn't of any recourse back to Redefine. So we focus just on the Redefine column there. You'll see our debt, excluding the held-for-sale debt, is sitting at 12.1 billion rand. As I said earlier, it's up about 2 billion rand on last year. But in terms of key statistics, if you look, after excluding the held-for-sale debt, we're sitting at 37.3%. As a loan-to-value ratio. We have upped our debt capital market funding, as I said earlier. It's now 20% of our debt. We would like to grow it to 30% in time. Having said that, since May, there haven't been many issuances from property companies on the debt capital market. I know Hyprop did one today, a 6-year note, which was quite well priced. So maybe there is still strong appetite out there for debt capital markets, but we will test that in due course. Our percentage of debt is 70% secured, and that's an area of focus for us for next year, with Moody's having alluded to the fact that if we want to get an upward rating, we need to lower that percentage. So we're going to work hard to do that. It's not very easy. Banks don't like lending on an unsecured basis, except one. We'll have to work on the other three. And then in terms of market value of assets secured, you'll see that 22 billion rand of our assets are secured. Now that provides a huge amount of headroom, given that 22 billion rand actually goes against 70% of, call it 14 billion rand. In terms of weighted average cost of borrowings, I've already touched on that. Our percentage debt that's fixed is currently 66%. Our target is 65%. As I said earlier, the markets overreacted to the May announcement on quantitative easing. It has come back a bit, but if we look in terms of our indicative pricing since then, the markets have probably gone up about 120 basis points, which has put huge pressure on new acquisitions, given that we need to fix our debt long term. So it's going to take quite some time for the sellers to come to the party in terms of reasonable expectations on yields, given where long-term debt now, new long-term debt, is going to be priced. Undrawn facilities, we've got about 1.8 billion rand of undrawn facilities available on demand at year end. And when we get to the cash flow analysis, you'll see a very small cash position. It's not to say we don't have access to money, it's just we are optimizing our cash levels. And that 1.8 billion there actually keeps me sleeping at night, knowing that we can phone the bank and have money on demand for Mark to do another deal. Our debt maturity profile, it's taken a long time to get to where it is. It's still work in progress. I think we need to fill in a few blocks post-2018 if we can, but certainly maybe 2016 and 17, and this is a hint for the banks to maybe see what they can do there for us, just to get those lines up a little bit and flatten the curve out. And then just to touch on Moody's, did refresh their credit rating. It was unchanged on the 5th of August, and we hope to please them even more this time round, and hopefully in due course we'll be able to score a rating which they will award us. In terms of net asset value, as you can see here, our net asset value grew from 801 cents to 871 cents. And what is a standout achievement here for us is the fair value adjustments of 31.2 cents that's been added to NAV. And that stands to the fact that we now invested in quality assets with sustainable revenue streams underpinning those values. The deconsolidation of Redefine International did assist. It's almost 20 cents. There was a little bit extra from the acquisition of Fountainhead. But in addition to that, the extra capital that we raised overall has been beneficial in that although we've got an extra amount of 58 cents, there has been a dilution as a result of the extra units in issue. Okay, then just looking at the cash flow, the only points I want to make here is you'll see that we optimize our cash flows as best we can. Unproductive cash is something that we're allergic to. You'll see only 40 million rand in Redefine's case at year end. Fountainhead had a bit more. But as you can see, it's a delicate balancing act, trying to get funding equal to investments. From a timing point of view, it's very frustrating in that in a number of instances, from the time that you shake hands on a deal to the time that you actually, apart from getting the lawyers to do the agreements, to actually getting transfer of the property can take between or at least 9 months, and in some cases it's taken us up to 18 months with some engineering to get us through to the 18-month period. So it's very difficult to land the fish once you've caught it. And that's where funding becomes very difficult. We fund the banks up in a panic normally. We need money. They rush to our aid, and unfortunately we can't draw because we're waiting for the asset to transfer. Hopefully, in due course, we'll be able to speed that up, but that is one of our big challenges. Just looking at risks, I think black swan events came about from the GFC. It was a term that was introduced then, but it seems to be becoming the norm now. I think we're becoming quite used to the fact that there is going to be some sort of shock that we've never thought of, and someone will rationalize it to an extent that we would have thought that it's always been something that was there. So risk management for Redefine has taken on a new meaning. What we're trying to do is minimize the impact of the improbable. These risks aren't new to anyone in the property industry. I won't spend too much time on them, but I do think the triggers are areas which are beyond our control, and we can only manage within that space, which does result in quite a bit of volatility at times and does add to our cost base as well. Our unit holder profile hasn't changed much since the previous presentation that we've done. I think State Street is something of interest. That's a US-based custodian holding for a number of US-based funds their shares. As you can see, it's our second largest share. We've got about 23,000 unit holders, and you'll see that the top 10 hold just under 43%. If I just move on to the next slide, from a country point of view, and this is thanks to Mark, he pointed this out this morning, you'll see that from 2008 through to 2013, our international ownership grew about 10 times. But the real story isn't that statement. If you look at what our market cap was back in 2008, that 1.4% was worth 100 million rand, and that 16% now is worth 5 billion rand. So it's not a tenfold growth in terms of value invested in Redefine. And as you can see, the States is our biggest international investor by quite some margin. Just looking at Redefine's returns from a share price point of view, for the 12 months ended August, it was going great until May, until quantitative easing was announced. And then the wheels came off. You'll see we went from a high of about 12 Rand down to a low of about 9 Rand. And that is principally, apart from the movement in the bond yields, which you'll see had a similar trend. Redefine's a very actively traded stock. Our average monthly trade is about 1.1 billion rand, around 4% of our market cap, and by value of the sector, about 14% of the average monthly trade. So being a highly liquid stock, we felt the brunt first as a result of the change in sentiment brought on by Bernanke's announcement. It has recovered somewhat. Our share price is around 10.40 Rand tonight. So had we have carried on the slide until this morning or this evening, there would have been a little bit more red on the upside there, but nonetheless, certainly well below the high of 12 Rand. But I tried to do here, and Evan Jankelowitz is in the room here somewhere. We believe that Redefine as an investment is more like an inflation-linked bond, in that you've got a capital underpin, which appreciates approximately 6% over the long term per annum. And on top of that, you have an income return of about, call it 6 to 7% per annum in growth terms. That gives you, over the long term, 13 to 14% as a total return. So Mark came to me and said, let's try and graph our performance, not against the R186, which is just a normal government bond, which we track quite reasonably until recent times. You'll see there's a bit of a departure there, but up until then, it's been pretty close. But the inflation-linked bonds don't actually, until recently, since May, seem to suddenly have come into the picture. The main reason, I think, could be because of liquidity in those bonds. I chose these two bonds because they seem to have been the two most traded, given the volumes that I could see, or the values traded. But nonetheless, it's there for academic interest. And then just looking at Redefine on a standalone basis. Our net asset value, as I said earlier, was 8.71 Rand. But if I take the listed securities NAV within our IFRS balance sheet and exclude them, I get to Redefine's share of the net asset value, and that's 5.37 Rand. If I compare that to the market value or the linked unit price for the group at 9.16 Rand on the 31st of August, and once again split out the listed securities that are priced at the same date, you'll see that Redefine is priced at 5.51 Rand. That's a premium of about 103 times. That was at August, I admit. And that, if you roll it onto the 25th of October on the same basis, is at about 1.2 times. If you do it today, it's probably still close to the 1.2 times range, given that all the other counters have similarly moved up. If I now introduce the distribution per linked unit, and I exclude the contribution from the listed securities, you'll see that Redefine contributes 47.9 cents to our overall distribution. And if I once again work that back into the net asset value of 5.37 Rand, you'll see a historic return on the net asset value of just under 9% for 2013. And if I base it on the market values at August and October respectively, you'll see 8.7% and 7.7% respectively. Once again, if I drill down and I do it tonight, at close of play, it's probably closer to 7.5%, thereabouts percent. And in our view, Redefine on a standalone basis still holds some value. In our view, we feel that it does merit some uptick in terms of pricing. In terms of total return, I could not do this analysis with share prices, given that the August price wasn't great. So I went back to the growth in the net asset value of 69.3 cents, and I added to that the full distribution for 2013. That gives you a capital and income return of 138 cents, which in percentage terms relative to the net asset value of 2012 is a 17% return. So that's a book return. It's not necessarily an investment return. And the message here for me is that the fundamentals within Redefine are absolutely intact, and they do support a decent share price. Not currently the case, but we hope in due course that we will be able to convince the investment community that we warrant a re-rating. With that, I'm going to hand you back to Mark.